My name is Jim Weisel, Professor of Accountancy at Georgia Gwinnett College. In this video, we are going to introduce the concept of accounting for income taxes in our GAAP financial statements. So the basic idea with respect to accounting for income taxes on our GAAP financial statements is that we have two sets of rules that we use for financial purposes. One set of rules, US GAAP, and then the second set of rules is the tax law. And although there are a lot of similarities between the two, there are some potential differences. The two sets of rules are designed to determine the income that's generated by entities, but the underlying objectives are different. US GAAP, the objective is to provide information to the users of the financial statements, primarily the shareholders and other creditors and interested parties. The purpose of income tax return, however, is to determine the entity's tax liability. And so we have two different objectives trying to be achieved, and that's why we have two different sets of rules. So while there is a lot of similarity between the two sets of rules, there are some differences. And those differences primarily boil down into two categories. There are what are known as permanent differences, and permanent differences are accounted for in one way, and then temporary differences are accounted for a little bit differently. So let's deal with permanent differences first. Permanent differences, I think, are a little bit easier conceptually to deal with. So permanent differences are the result of transactions that under existing tax law will never affect the taxable income or taxes payable. So there's transactions that by law do not have an income tax consequence. So for example, interest received from investments on bonds issued by state and municipal governments. So municipal bonds is what we usually refer to these as. The interest received from municipal bonds is not taxable by federal tax law. Interest income from municipal bonds is income and is included in our GAAP financial statements, but by law, municipal bonds interest income is not taxable at the federal level. The federal government has decided or has determined that they cannot tax the interest income generated by state and municipal governments. So there's that separation of the federal government from all the state and local governments, and this is one of the results of that separation. So while interest income would appear on our GAAP financial statements, it'll never be part of our tax return. It is specifically excluded from our tax return. And then there are other examples that I have listed here. Investment expenses incurred to obtain tax-exempt income is not tax-deductible expense. So the income earned from municipal bond investments is not taxable income. In contrast, or similarly, the expenses, whatever costs we incur to make those investments and to maintain those investments, are not tax deductible. Life insurance proceeds on the death of an insured executive are not taxable. And then similarly, the premiums paid for those life insurance policies are not tax deductible. So for example, last year or the year before, when Steve Jobs passed away at Apple, Apple, I'm sure, probably had a life insurance policy on him, and the proceeds from that life insurance policy are not is not taxable income. The premiums that they paid for that life insurance policy similarly would not be tax deductible. And then there are some other less common areas where there could be some permanent differences. And these are, again, differences between revenue and cost recognition, revenue and expense recognition, that are expected to remain forever. There is no expectation that the federal government will ever tax municipal bond income. And so there are other things here as well. For example, compensation expense from employee stock option plans. That's not tax deductible. Expenses due to violations of the law. You violate the law or an entity violates the law. They are not allowed to deduct any expenses that are related to that. And then there are certain dividends that are received from U.S. corporations that are not taxable due to the dividends received deduction. So the most common are up here at the top, where we have investment income from municipal bonds, state municipal bonds, and then the life insurance policies. So the way that we are going to handle the accounting for these permanent differences we'll demonstrate in a follow-up video here. But that's just a quick explanation of the permanent differences. And then we get to what are known as temporary differences. And temporary differences are, again, a result of revenues and expenses that are included on a company's income tax return, but at a different time period than what those revenues and expenses appear on the GAAP income statement. And so there are some differences between, again, GAAP and tax rules that can result in revenues being recognized in one year for the GAAP income statement and might not be recognized until the following year for tax purposes, or vice versa. And the same thing with expenses. These temporary differences are recognized or initially recognized in one period, and then we need to maintain that information and wait for those temporary differences to reverse themselves or turn around. This is an area that's a little bit complex, both conceptually as well as mechanically from an accounting standpoint. But here's the fundamental issue. We have a revenue item. The question is, when is it recognized on the GAAP income statement, and is that revenue recognized in a different period on the income tax return? If the revenue will eventually show up on both income statements and it's just a matter of a timing difference, then that's what's referred to as a temporary difference. And so we have some definitions here. I'm going to scroll down to the matrix to try to explain a little bit about how this works. So we have revenue and expense items. Revenues and gains are treated the same way from a tax standpoint, and expenses or losses are treated the same way. And then we have timing issues. So for example, items reported on the tax return after they appear on the GAAP income statement, or items reported on the tax return before the GAAP income statement. And I'm going to go to, as way of an illustration, just go to one or two items here to explain to you how this is going to work. So let's take a look over here. We have accelerated depreciation on a tax return, and we use typically straight line depreciation on the GAAP income statement. So when we buy an asset, we will depreciate the entire original historical cost of the asset minus any sort of salvage value over its useful life. That's true under both the income tax return as well as under the GAAP income statement. The issue is, or the challenge is, that the timing of the dollar amount of depreciation in any given year may be slightly different. So let's take a real simple example and see if we can think our way through this. Let's say we buy an asset for $10,000 and it has an estimated 5-year useful life. For GAAP purposes, what we would do is take $10,000 divided by 5. That would be $2,000 of straight line depreciation each year. However, tax law says that we can use something called MACRS, Modified Accelerated Cost Recovery System, which is just basically an accelerated method of recognizing depreciation. So in the first year, we might recognize $2,000 of depreciation for GAAP purposes, But makers may actually allow us a, say, $3,000 deduction for depreciation in that first year. Over the course of the useful life, total depreciation will be $10,000, but in any given year, the dollar amount of depreciation may be different. So what happens here in this case, we have $3,000 of depreciation for tax purposes, and we only have $2,000 of depreciation for GAAP purposes. That is an expense item, expenses or losses. That's an expense item that is being reported on the tax return before it makes it to the GAAP income statement. There's more depreciation deduction on the tax return than there is depreciation deduction on the GAAP income statement. So we have an expense item that's being reported on the tax return in advance of or before it makes it to the GAAP income statement. That's going to result in what's called a deferred tax liability. Effectively, what happens is if we get a larger deduction for tax purposes, our taxable income is going to be temporarily smaller than what our GAAP income statement would show. So if we have $3,000 deduction versus a $2,000 deduction, our taxable income will effectively be $1,000 less. We've got more expenses. It will be $1,000 less as a result of that. That's a temporary shield of income from taxes, and that's going to result in what's known then as a deferred tax liability. The rest of the matrix goes together. Once you understand how one square works, the rest of the matrix kind of goes together as you might expect. If there are revenues that are recognized on the tax return after the GAAP income statement, so instead of expenses being recognized before the GAAP income statement, we have revenues recognized after they appear on the GAAP income statement. That's also going to result in some deferred tax liability. And then the opposite corners here are going to result in what's known as deferred tax assets. It probably doesn't make a whole lot of sense to try to describe all of these other areas in the without some sort of context. And so we'll illustrate, or I'll have some additional videos that will illustrate mechanically how this is going to work. But that's a quick introduction to the topic of accounting for income taxes. So the basic idea is, again, we have two sets of rules. We have GAAP and we have tax law. There's a lot of overlap, but there are some differences. And those differences are generally classified into two categories. There are these permanent differences, items that will show up on the GAAP income statement, either revenues or expenses that are legitimate part of the GAAP income statement, but will never show up on the tax return. And then there are these temporary differences where revenues and expenses can appear on the GAAP income statement in one period, and that same revenue or expense will show up on the tax return in some different period. And those are what are known as temporary or timing differences. So that's a quick introduction, and I will follow up with some additional examples and how we actually, from a mechanical standpoint, how we measure, recognize, and disclose these permanent and temporary differences.